Hey everyone, we're live. No, I can't do it. I can't do it. I'm not on it. I'm not on it.
Nope.
Ahmed can do that, bro. I don't know how he has the energy to do it. Maybe it's because he's like 20 something and he's like fresh. I'm like a ragged old man trying to like, let's do a podcast.
You're old.
Let's do a podcast. So
Don't say we're old, man. We're not old.
We're old, bro. We got the white hairs coming in.
Yeah. I don't know. I got all this, man. This is all IT right here.
Yeah, but it's good. That's how you know that we've got wisdom. All right, everyone. Welcome to the Hidden Edge podcast with me and Sam. We're going to be going over a few things macro related today, a few things that are interesting to us in the micro side, which is individual companies. So without further ado, let's just get right into it. So the first topic that we are going to get into is the FOMC. Jerome Powell spoke today, basically outlined that they're going to keep the rates unchanged, which is pretty predictable. No one really expected rates to be cut or them to rise. So it wasn't any sort of surprise there. What we did get a little bit of a surprise for the markets was that overall, September looks likely to be the month that we get a rate cut, but that's under the guise that all the data points that are coming out between now and then remain bullish for interest rate cuts. What does that mean? That means unemployment, staying steady, maybe rising a little bit. You've got jobs numbers that are I wouldn't say like really good or really bad. I mean, see, this is the weird part about the market right now. If there are more jobs out there, people are like, oh my God, the economy's too hot. That's bad. Usually in a healthy market, a lot more jobs is good because that means that, you've got economic expansion happening. So right now you've got a little bit of a weird situation where more jobs equals bad because interest rates stay higher. And then the other way is usually, unemployment's going higher. That's usually a bad sign for the economy, but it also means that, hey, the future rate cuts are probably coming. So the market's kind of in like bizarro world right now when it comes to comes to unemployment. So
it really is. I mean, there was that point where it was like, oh, bad news, good news, bad news, good news. And then now we're like kind of in between, like you're saying, it's like, well, bad news depends on how bad the bad news is. And then we'll determine if it's bad. But good news is good because that means we're still doing good, but not too good because we're doing too good and that's bad. It's like the market's going to be crazy like that right now in a rare curve. I mean, I really the sentiment that I still see today is that, like you were saying, when I say sentiment, I mean like positioning in this case, is that I got the chart up, not 89% chance. It's pretty ironic because earlier today, I checked this morning. This is live data from Fed Funds Futures. This morning, this was like 95, 96% of a rate cut in September. And then I checked this after the market closed, and then now it's 89%. I was like, holy crap, are they pricing out a rate cut? And then I looked over where I'm pointing at the arrow. There's an 11% chance they're going to do 2 rate cuts in September. Like, at that point, the market's getting a little bit ahead of itself. And that's when I kind of start to worry.
Yeah, I don't necessarily think we're going to get 2 cuts unless the data that comes out is going to be uber bleak. If it's really bleak, then the Fed is likely to get 2 rate cuts. But I don't see that happening. I think the consumer is still pretty healthy. Delinquencies are starting to rise, but they're still well within the historical averages. So it's nothing that it's like, oh my God, everything is falling apart. So we can safely say that the Fed is probably going to cut at least 1 quarter basis point. And then after that, it's going to leave room for the rest of the year to get another 2 out there. The question that we should all be asking ourselves is, and if we're building models on prices on certain companies that we own, what is the terminal rate that the Fed is likely going to get to? Because I don't think we're ever going to get back to 0 interest rates again. I mean, 0 interest rate means like basically the amount of money that you're borrowing for such a discounted rate that it's super inflationary. So I don't think people are going to go that route. Now, I mean, a lot of things would have to go really, really wrong for that to happen. So I don't think we'll necessarily get there anytime soon. So for me right now, I'm basing my models off of like 2.5 on the federal funds in the future, which means that if you're looking at a company with, let's say, a triple B credit rating, then they're going to be paying a certain percentage above the SOFR, so use that as the benchmark. And then after that, you can just kind of layer that on top of debt and figure out, okay, like the interest payments on this company under this circumstances is going to be X, or the cost of capital should be close to X. And then figure out like, okay, this is how much the enterprise value is, and deduct the debt, and boom, you got yourself a price target. So what's good is a lot of companies right now that we do like, they do have like December 2026 options, like the cruise lines, so that we can actually buy out really, really far out. On the other hand, in September, we're going to get the new 2027 leaps. So maybe that's something that we can also take a look. Yeah. Someone's asking a question. BBB is how much higher than SOFR? It fluctuates. But it's usually, let me see, like 200 basis points. Let me find out. Go ahead, Sam.
What's the BBB? Oh, triple B credit. I actually don't have access to that. I have no idea. But I mean, I do agree. Like if the terminal rates are 2.5%, which I do think that they are, because technically speaking, target inflation for the Fed is 2%. Jay Powell has been talking about 3% or a 2% handle is good enough for us, but as you can see right now, it is, I think it's closing in the 2%, and the market's already pretty much pricing in a rate cut. But I think what the market's anticipating is for inflation or disinflation to start accelerating. And we kind of see that in the housing data too. Housing is just doing terrible right now. At the same time, me personally, if you're going to buy a house for primary residence, like go ahead and buy it. Like don't even wait for rates or anything, because you're going to keep on waiting. But, in terms of investments properties, which is where the big money comes in, a lot of them are really sitting on the sidelines and the waiting. And like you guys were discussing in FJ, it's like, you're not like the people that are going to buy houses for investments, or the business that they're going to go hard with it. Like they're not going to wait for that one rate cut. And it's like, okay, guys, let's go in. Like you're saying, like they're going to wait till rates drop down like a good 100 basis points, or 1 or 2%, 1 or 1.5% till they start getting in there. So, we'll see what happens with that. But I still do think if we're going to be forecasting a recession, which there is a good possibility we might get a mild recession. If that does happen, it really is dependent on, not really dependent on, but there is a forward indicator that we can look at, which is the yield curve. And I actually got a chart here that I want to share. Sure. I was already sharing it. Okay, there you go. And let me go over here. Oh, I actually had it in trading view. Hold on 1 second, guys.
Yeah, we do that. Let me share this one real quick.
Yeah, go ahead.
This will help. All right. So if you guys see this is the yields on different instruments. Okay, using a benchmark as the federal funds rate. So you can see here the federal funds rate post-COVID went down to absolutely zero. So it was zero. So at the time, if you look at the corporate triple B right now, it was about 2.25. Like at some point, it was like only 200 basis points. But for the most part, it's going to travel between 2 and 2.5. For me, I'd probably say 2.25. So right now, the federal funds rate is close to 5 and change. The triple Bs are like on a constant currency basis, they're like 5.7. The reason why is because everyone is anticipating rate cuts. So you can see here the effective yield is like 6 point. It was in 2023 in October. It was like 6.72, and then a lot of the newer issuances probably ended up helping drag this down. And so right now, according to Fred, the average triple B is yielding about 5.4%, which pretty much is signaling that, hey, there's actually like demand for corporate credit probably out into the future that's going to be locking in like 5.25, 5.5, or close to it. Interest rates. So this likely will go down. This is not going to go down by that much. So even if, let's say, it goes to, I think about 2.5, right? Like in the federal fund side, the effective yield it's probably going to be still like close to 5%. It's not going to be like super, super low, maybe like 4.25 to 5. Now, remember, this is an aggregate data that you're seeing right here with the triple B. So every company, they're going to have different debt profiles, and based on like the maturities, based on all the other stuff that they have, their credit worthiness, even if they're a triple B, they could theoretically get upgraded, right? So if you look at this right here, this orange line, right now, that's AAA corporate yield. So AAA is trading relatively close to triple B, which theoretically shouldn't necessarily happen. Like usually triple B is not as good. Usually when you start delving into like the triple C's, that's when you, or even double B's and below, that's when you start to get non-investment grade stuff. And that's where you see huge discrepancy. So like if we edit and we add like, let's see, triple C. Yeah,
I gotta learn to use the Fred like that, man.
Yeah. So you can see here the triple C's, which are very like speculative, their effective yield is close to like 13-14% right now. You know, during COVID, you were still able to eke out like a 6.5%. But the thing is, there's a lot more risk with triple C. Like triple C is, it's like uber speculative. Like you really need to be very cautious when you buy anything that has a triple C credit rating. The good thing is,
I'm just kidding.
Huh?
That's a US debt. I'm just kidding.
Yeah, I mean, I've bought triple C related stuff. It's not. It's sometimes what happens is the market can really like get hit hard on a cyclical business, and then what ends up happening is their debt gets downgraded really hard. And now all of a sudden the debt that you had goes below investment grade. And the minute that it gets below investment grade, a lot of these funds have to automatically start dumping it. When they start dumping it, all you need is like a rotation to happen, and boom, now that bond that credit instrument does freaking phenomenal when the underlying asset changes. So as an example of some places where I've made money like this, I've done oil deals where what happens is the price of oil has something happens and you have an oil shock, and all of a sudden oil prices go down by a lot. And so what ends up happening is oil companies, they typically have a lot of front loaded capital expenses. So they take on a lot of debt. Now, the debt can be far out, like 5 years, 10 years, whatever. And now all of a sudden you have this sharp drop in oil prices. And so what ends up happening is now Moody's, S&P, and God damn it, who's the third one? I keep forgetting the third one. Standard & Poor's, Moody's, and Fitch. They're like, oh, look, they're not making money. They're cash flow negative. That means that they're not that credit worthy. Get rid of them. And so now all these people dump these companies, and you can buy a lot of these corporate debt for like pennies on the dollar. And then a year later, all of a sudden the Saudis, they come in and they start, you know, playing their games. The oil price goes to 100, and boom, now all of a sudden these companies are generating tons of free cash flow. And now you can basically, the debt gets upgraded back to like triple B, you know, double B, and you know, or triple A, not triple A. You will probably rarely ever go from triple C to triple A like that.
Yeah.
But then you end up getting triple A or double A again, which is investment grade. And now that those bonds end up shooting back up again and getting back to a normal level, in which case now you make huge amount of money both on the capital appreciation, but then like while you wait for the market to kind of like catch up to itself, you're making money on the yield also. So that's why we're in BPYPM. So
you
know,
I wanted to also share this chart in terms of the yield curve. So the yield curve again is the 10-year yield minus the 2-year yield, and in this chart, as you can see, it's pretty much been inverted since June of 2022. And see, now when you see these the gray shaded areas, this is when recessions happen, and a lot of people were calling for the recession as soon as it started inverting, because historically when it starts inverting, it uninverts or steepens within like a 6-month period. But this time we're going at about 2 years. So it's this whole like recession prediction has been going on for like 2 years. And that's the reason why there's so many bears in the market, because they're like, this is like the holy grail of indicators for all these bears, the yield curve, the yield curve. And, actually, we've been steepening pretty materially since in the last few months. I actually thought we were going to uninvert last week, but then we again inverted about 10 basis points. And if we look closer here on the 1 year, we can look at it. We can kind of zoom in. We're pretty much trending up. But the way that these things work is like, if it's going to uninvert, it's not going to uninvert gradually. It's going to happen like within a couple of days, and it's going to just spike up. And things that you got to look out for are major economic events. Like this Friday, we got unemployment, ADP non-farm payrolls. Those are really big indicators. And you could already see that, the yield curve starts to go up a little bit when the market starts to price in more rate cuts, because the anticipation is that, yes, we're going to have a soft landing. There will be rate cuts. But when they start pricing in too many rate cuts too fast, that's the anticipation that something bad is actually going to happen, where the Fed has to react very quickly. And they have to, the severity of how they're going to react is pretty large. Like, I'm talking like 4 cuts in one meeting, or maybe an emergency cut. Who knows? I don't necessarily think that's what Powell wants to go for, which is the reason why whenever the market prices in a rate cut or whatever it is, he takes it. He just takes it. And he's not saying anything about the next one, because he knows that all the data can change before the next meeting. So if he makes that commitment to do a rate cut in the meeting ahead prematurely, then the markets will quickly price that in, and then it will introduce volatility into the markets, whether it's up or down. So some people were thinking that he was going to do a rate cut today. It's like, there's a 96% chance he's not going to do a rate cut. There's a 96% chance that he's going to stay, and he did stay. Like, so if you're betting on like huge, volatility swings, whatever, that he's going to do a rate cut, that didn't happen. But this is all independent from how the market's going to react. So that's a whole different ball game. But if you think about economic wise, like there's a pretty good likelihood that we might get into recession, and that, or maybe he'll manufacture a somewhat hard, softish landing to the point that, there's no blowback to the economy. But again, the data can just change overnight. Like we don't really know what's going to happen. What we can do is look long-term and think like, how can we position our portfolios in a way to maximize the gains and the probability of us having a winning trade, and not looking something like in a week or two, but looking something at like 2 years from now, right? Like with the cruises, for example, Hershey's, commodities, value plays, and so on, or even mega caps too. They're the ones who are really going to benefit regardless of whatever the environment is. In a high interest rate environment, low interest rate environment, the mega caps will benefit no matter what. Yeah. So, that's really what I wanted to add to that one. You got anything else on the FOMC or macro, Kris?
Yeah, let me just share one thing, because
Sure.
it's on the topic. So this is the chart that everyone should theoretically memorize a little bit when they're investing. It'll save you a ton of headaches. Usually these are the ones that you just have to remember. Investment grade versus speculative. Anytime you see anything that's below triple, like 3 Bs, so that's the thing you have to remember. If it's 3 Bs or below, then it's more than likely speculative grade, which means that a lot of funds can't even bother investing in it. So this is a huge step up. So if you have a corporation whose average debt rating right now is like here, that means that it's speculative. So what's good is that as the business conditions improve and they jump from this tier to this tier, there's a huge discrepancy, a huge difference in the credit quality. And so what ends up happening is a lot more, how do I say this? There's a lot more benefit to the company to get back to investment grade. When it comes to investment grade, each of the rating agencies, they have different benchmarks that they use. So right here, if you see triple B minus, this one Moody's uses Baa3. So you just have to look at this one and just remember what this looks like a little bit. So
I was gonna say, like, whenever you go from you took out the chart, but triple B minus, whenever you go below that, that's when you get to high yield and junk. But if you look at the here, let me actually bring up this chart real quick from moving to the next topic.
Another thing to also consider is that depending on which the company's type of debt, it could be worth a different investment. It could be worth a different grade for that debt. So certain debt, like secured debt, it's actually like secured by assets, which means that let's say the company goes bankrupt, these assets are now in question. They belong to the debt holders, right? So they get first priority. So secured debt typically has lower yield because there's a lot more safety to it. So the rating on those could be like investment grade versus unsecured debt, which is just, hey, you're pretty much an unsecured creditor for this company, which means that debt tranche is going to be rated at a different safety level, you know?
Yeah.
So.
Okay, so what I'm going to do here is we can move on to the next topic regarding the US dollar. You guys, you touched a little bit on this on the FJ podcast. So I kind of wanted to broaden a little bit because I do have some stuff to say about it. I'm pretty sure you want to expand on it regarding the dollar weakening. One thing that I want to point out with the US dollar is that, let me just share the chart here real quick. So the US dollar is usually negatively correlated with risk assets, which is in this case, the stock market. And if you have a day where the US dollar drops, it's most likely that risk assets will rise or the market will go up. Mostly because whenever people sell stuff, they're technically selling their stock and buying the US dollar when you really think about it, which is making the US dollar rise when the stock market goes down. That doesn't necessarily happen all the time, but that's usually how it correlates. And when you see the US dollar drop, that's also negatively correlated with bonds. Bonds or TLT, usually long-term yield, they end up going up when the dollar goes down. So what you saw yesterday, today, what you saw with FOMC, the markets ripped, right? And the US dollar dropped about 1.73%, that's a pretty magnified move for the US dollar. That's like somewhere around the 1 to 2 standard deviation move. When that happens, it's like risk on, baby. Like junk bonds were bid up, high yield was bid up, the markets ripped, of course, but it was extremely volatile toward the end of the day. Of course, there's a lot of speculation, but that's kind of how the dollar works. And usually, too, if you think about rate cut cycles and rate hike cycles, we were in a rate hike cycle, and the U.S. dollar, you can see in this chart, the rate hike cycle started around 2021 into 2020, middle of 2023. The U.S. dollar it ripped up all the way to 115 and then pulled back very quickly once the Fed kind of signaled that they were done, because once the rate hike cycle is coming toward an end, the market sniffs that out. They start to buy risk assets. So basically, they're technically selling their US dollar to buy risk assets. And this works also with a lot of currency pairs. But for the most part, the US dollar is kind of an index of it's against 4 different currency pairs. And I think that's the British pound, the euro, the Chinese yuan, and the Japanese yen, I believe. And this kind of goes hand in hand with the Japanese yen. If I bring up this chart of the Japanese yen, you can see here pretty much since they started hiking rates that the US dollar versus the Japanese yen, the US dollar has been pretty much dominating the Japanese yen. And we kind of topped out here around 161. And since then, we've had a material drop. And this is really on the back of the fact that Japan is hiking rates for the first time in 2 decades. They've been on a monster deflationary regime since the early 1990s. And since then, they've been cutting to the point where interest rates were actually negative. So basically, every single foreign trader, they're just selling and they're just shorting the yen. So when the Japanese yen reverses, it'll be the nastiest reversal you've ever seen in your entire life. This thing is one of the most crowded and massively short currencies in the entire FX market. So that really kind of gives me an idea. And you mentioned this too.
That's why yesterday, if you saw my post on Twitter, it was a little bit cryptic, but look at YCL. If you could put it on TradingView. Yeah. So I actually bought some calls on YCL.
You jumped in, didn't you? Nice.
I had to, man. It just made a lot of sense. So look at YCL right now on like if you look.
This is a monthly chart.
Yeah, this is a monthly chart going down. So what I did was today I was like, oh, you know what? I see the Bank of Japan is like on a rate hiking cycle. You're going to have
Yeah.
Powell kind of come out a little bit dovish. Look at that candle today for this one. This is a triple leveraged long.
No, double leveraged.
Double leverage, yeah. Double leveraged long Japanese yen, short dollar. And literally for the last week, it's been just shooting higher. Yeah. Just put it on line chart mode.
Oh, line. That's actually a good idea.
Yeah. Look at that huge spike.
That's crazy, man. This is how big is this move?
It's about 10-15%.
That's a huge move for a currency.
Yeah.
Huge 8% move in 21 days. No, 15 trading days. That's a massive move.
Put it up against the YCL. Put it up against YCL.
Geez, man. You're gonna get me so degenerate right now just looking at this thing.
Look at that.
I'll put it in candles. I gotta put it in candles. Like, this is insane. You know, I wouldn't say I've gotten
zoom into
murdered.
it, like do like a 1 month at the bottom there. Yeah.
Oh,
there you go. Right there, and then just do a line chart. Yeah. So you can see that the trend is working, you know. So it literally went from like 19 to right now 23. Yep.
Yeah. I've gotten murdered on this trade one time. And I've got hit with a stop loss. So I've taken 2 stabs at this trade. And clearly I've lost. The first time probably was because I bought shares of YCL, and this is when I wasn't really thinking too well with this trade. I was in cash probably ending 2021, and I want to put a trade on. So I bought just YCL shares, and I got murdered. I think I lost like 25% of a pretty big position. I mean, it wasn't huge, but it was a pretty big position for a macro trade. And then I took a stab again, probably when I think it was a couple months ago, when people anticipated the BOJ like starting to talk about, or no, ending what was it called, the yield curve control. And I got murdered on that because it was like so many people expected it, so it just didn't happen. And then I got stopped out. I did YCL calls, but like they were like monthly, so you know the time was against that. Like what was or I don't know if you want to talk about the trade you actually put on
December of 25. I'll show you right now.
That's probably a good idea, dude. That's probably a good idea. You definitely need time with that. Like, this is YCL, so it's a 2 times leverage ETF, which means that there's the way that the YCL is done is usually through call debit spreads, but because the ETF managers already take care of that for you, they're just decaying on the actual ETF. And I don't know what the expense ratio is on that, but I guess it doesn't matter when you're in calls anyway.
So that call, because I only have 5 of them, is up 58%. At $23 calls for December.
You got it yesterday?
This morning. Picked it up very early this morning. So it's up right now 58%.
I'm surprised. I mean, I'm surprised the move continued throughout the day, because usually when the US markets open, like, they just take profit, but the overnight FX markets, they bid that shit up. But that's pretty good, man. I mean, you got you got a year and a half for that to play out, and they just
no, it's December 25. I mean, December 24.
Oh,
because they don't have them going that far out. Like,
literally, leverage plays. Yeah,
the leverage plays are not going to be that far out. YCL especially. So like I said, it's an exaggerated move to the upside that really is like capturing that alpha.
Yeah,
I don't plan on being this for, like, especially the options position. I don't plan on being on it for a long-term thing. I am probably just going to downshift, like take some of those profits and downshift to just the yen itself and just be in a long yen ETF. So
I mean, definitely long-term wise, if you just want to buy FXY is basically for people that don't know, that's like the actual ETF that is just based on the currency pair, the FX markets. So you're not really getting that much decay in that at all, and you can hold it for a long period of time too. YCL, it's kind of like Boyle, or the 2 times natural gas like ETF, the Widowmaker.
The Widowmaker.
Yeah, you'll get murdered if you have like one really bad day, and then when you have the call options, like that's like the type of thing where like it is strictly a trade. Like there is no long-term thesis when you're holding calls on a 2 times leverage ETF. unless you're degenerate like me. So, there are times when like a little bit of degen comes out, but you seem like you're a pretty good risk manager. So I don't think you're going to go for that one.
It's a very small speculative position.
Yeah, I hear that.
One of the things that I'm trying to do now is just hedge against the US dollar collapse. I won't call it collapse, but just right now, the federal government just keeps spending money like there's no tomorrow. So like, this is why I bought a little bit of Bitcoin. This is why I bought this, because you want to make sure you're hedging against any sort of idiocracy that's coming out of Washington, So maybe one day those Japanese yen you'll get back to like the 80s and the 90s. That's happened earlier this decade. It was at one point the US dollar was like $1 to the yen was like 80-90. So
yeah, the DXY, like I was saying before, the dollar is literally going to be trending down from today until the end of this rate cut cycle, because it's literally people selling the US dollar and buying risk assets, buying properties, and so on. And really the only reason why people are buying the US dollar is to use as a proxy to be able, not a proxy, but using as like a stepping stone to buy US assets.
Treasuries.
Treasuries. Like, because once you buy the treasuries, you're basically selling the US dollar. Forgetting it. Like, there's always a buyer and a seller at every single trade, but it's when one of them becomes more aggressive than the other that's what actually moves the market. Like sometimes some people say that like, there's no buyers in the market. It's like, no, that's not true. There's always a buyer, but the sellers are just much more aggressive. That like they're literally just taking out the bid. Taking out the ask and so on. But yeah, I was going to talk about the deglobalization, but I think we're already over the allocated time for this portion, so we can just move on to the next one. You did touch on all the fiasco that's going on in DC, and I mean, it's not really news at this point, but everyone is clearly already up to date that Biden has dropped out of the race, and Harris has came in. And the thing is, leading up to that event, they were already discussing it, about Joe Biden's condition, and all this stuff. Like, I don't want to get into any conspiracy theory or anything regarding that, but it's funny how when I'm looking at the polls, let me actually bring up the polls right now. One second. Sorry, guys. I'm just getting used to this thing. Like, it just takes some getting used to. And
dude, you know what's funny? I actually think Kamala's gonna win. I think Kamala's gonna win because
she has a pretty good chance, man. Like, I think she's beating Trump right now in the polls. Let me share the screen so we can start talking about this.
Yeah,
here it is. Okay, I don't know how reliable the site is. I literally just Googled like polls website or whatever. But if you look at the polls that ended yesterday, Kamala is beating Trump, and if we look at, I think I could actually get the do you know how to use this chart, or do you have access to any polls or anything that you look at pretty periodically? Really. Okay. No. I mean, if I kind of scroll down here to earlier this week, it was pretty much tied, right? Like you had it was pretty much 1-1. But if you look at as the week progressed, Kamala kind of took the lead. And I mean, these are polls, like these are surveys. So, maybe the population isn't really spread out, or maybe it's too thin, whatever. Only certain areas. But if you look at the consistency of where all these polls are coming from and what they're actually rating, like Kamala is like she's taking the lead right now. And I don't know, man, this might be a tight race, and I'm actually kind of surprised that the market is still rallying on the back of what the Fed is going, because what was it, just like a week ago the market cared more about the presidential election, but then now today they care about the rates and nothing changed. So it's kind of makes me wonder, like, what the hell's going on here?
The funny thing is, the way I see this this election is, we need someone like Trump in the office, but we deserve Kamala. She's gonna come in, and this is my level of thinking. All right, I want Kamala Harris to win the presidency, but I want the Republicans to win the House and the Senate. The reason why is usually if you want like economic expansion, you just want government kind of divided, so they can't fuck shit up more. Like, that's the role of government, to mess things up so that they could theoretically fix it later, right? all the policies that, like, right now, if you look at the bubbles that we end up getting into and the problems that we end up having, it's because usually one party gets in charge and they start to do dumb shit. And then 5 years later, 10 years later, they figure out, hey, wait a second, all the shit that we came up with is actually pretty stupid. We need to start reversing it. So the best times for us as investors is typically when no single party controls both sides of the aisle and the presidency. So that ends up helping tremendously fight against like the stupidity of Washington, because there's always this thing where, you know, you can't do one thing or the other like too aggressively. So I don't know. We'll see what happens, but I think Kamala is going to end up winning this. The one thing I noticed, and please guys, don't fault me on this, like white women, they're like 90 something plus percent going with Kamala, right? Women in general are going towards Kamala. And there's one singular topic that she just keeps hammering. And I think that's gonna get her to the winning thing. And that's abortion. Like, abortion is one of those things that keeps on coming up. And she's just like, Trump is anti-abortion. Trump is anti-abortion. Trump is anti-abortion. And it plays so well to all of these women who are like, my body, my choice, to the point where they're like, I don't care about the economy. I don't care about any other issue. I just care about my abortions. Like, that is the only thing I care about. And it works, you know? So I think abortion is like Trump's kryptonite. And JD Vance definitely doesn't add to the value, because he's coming out sometimes and saying, oh, I mean, I think it was just a soundbite, but he got caught in that soundbite, and now everyone thinks JD Vance is like an anti-woman person, and like this whole thing with him being weird, I don't know. So
I think like once that happens, like this dude can like seriously he can just cut his VP or running mate. Like, I mean, yeah, that's the thing with Trump. Like, he could just do whatever he wants. Like, how many times did he fire his chief of staff? Like, loads of times. And that chief of staff would testified against them. Like, it was just, you know, he could just cut them like that. So I think the market could be just as volatile as the election goes, right? So like we saw like last week that, you know, Trump was winning and then Harris came in. Now Harris is winning. But I mean, at the end of the day, like you were saying, and there are actually statistics that back this up. I don't have it right now in front of me, but the market really performs better or outperforms on years or presidential cabinets where the government's divided, because of the fact that it can create like that momentum in the market. Because if it was all sided, like, you know, if you got a Republican president and then the Senate and the House were Republican, then it doesn't mean that everything's going to go through, but it just means that you're never going to have like those bears and bulls fighting each other for the market to continue climbing a wall of fear. Right. So if you have this divided divided government, you know, whether it's Democrat as president or and the Republicans control the House, whatever it is, then you're going to have that wall of fear that the market can climb. Otherwise, like, there really won't be any unknowns. And if there's no unknowns, I mean, it means everyone's going to be a bull. And if everyone is on one side of the boat, you already know what's going to happen.
So can you highlight one of those comments? It's Kris can't wrap his head around the fact that women want to protect their right over their body. So
where's that?
It's James Burns. So let me address that. Let me address that real quick. I can definitely understand that. My wife, and I'll reveal something to you guys. My wife, we had a miscarriage, and well, we had a miscarriage, but before we had a miscarriage, the baby was in a very awkward place inside the womb. So we might have actually needed to get the abortion to protect my wife's life. Okay. So I'm for abortion, especially when it comes to saving the woman's life. So there's no, hey, Kris is anti-abortion and all that stuff. So I'm not anti-abortion by any means. The problem that tends to come up is that is the singular issue that a lot of women, they focus to the point where it's too much to it, right? So as an example, Trump and the Republicans, they're trying to say, you know what, it should be done by state basis. Let the state decide, you know, whether or not abortion should be legal at 13 weeks, at 26 weeks, if there should be carve outs and all the other stuff. Now, the reason why Trump is saying that is because that plays to the Republicans, especially in really, really cherry red states, who have tons of evangelists who believe that abortion is completely wrong. And also it plays to the states that think that, hey, abortion should be, free and clear all the way until pregnancy, like until the child, the birth of the child. Like literally there are states that says you can abort up to the, right before even into the third trimester. So a lot of this is just people not willing to compromise a little bit. And so each side is kind of like, like digging in their heels. And the problem is, if that is the singular issue that you are going to base your voting decision on, and you're ignoring everything else, that's a problem, because now all you're doing is you're basically voting for that one singular issue. So I think a lot of this stuff should be done more based on proposition nationally, like figure out like, okay, let's have a vote nationally. Should abortion be legal at 12 weeks? Nationally, should abortion be legal at 24 weeks? Nationally, should abortion be legal right up until the birth? And see where it comes up. And then after that, you can work on that with Congress and say, you know what, let's put an amendment out there that codifies this and call it a day, and let's put this issue to bed. But that's not what's happening. So.
Yeah, I mean, regardless of whatever happens, I'm really thinking that for me, I live in California. I already know what our state's going to vote for. What I'm thinking is what matters more are the swing states, right? So it's Florida and Pennsylvania. I forget the other states. That's the one where it really matters. Which president's going to win those votes. That's really what it's going to come down to. And coming into last week, I thought, okay, well, Trump's got this in the bag. And then when Harris came around, that's when it's like, this might actually be a pretty good election, right? Like everyone thought like this is all going to be a landslide. If every single presidential debate is based on Biden and Trump, then this is just going to be a landslide for Trump. But now that Harris is on there, I think the next thing that we need to see is how does Harris react to Trump when she's in the debate against him? I don't think anyone's ever seen that. That one's going to be really interesting to see how they actually interact with each other when both on stage.
Sadly, I don't have a lot of confidence in Kamala's ability to actually get the things done, because I feel like she's demonstrated as the VP and some of the things that she was put in charge of, that she's quite ineffective at them, and that she isn't the type that really takes a stand on anything. She just kind of like, laughs things off a little bit, comes off a little bit kind of like, not serious. So in that respect, I would say that I just don't have a lot of faith in her ability to get things done. But maybe that's also a good thing, because when you get too many things done, it can, once again, the government comes right back, right? Government's here to help you out. So, Kris is being anti-Indian again. Yup. I can't stand Indian women, bro. I'm married to one of those. Things, bro. Nah, I'm not doing it. Nope.
Things.
Nope.
That's
Indian
the biggest of calling
boom,
someone a thing. Like
flag.
It's like, okay. It's like my wife's Filipino. Like I ain't calling her a thing. I'm gonna get my face smacked when I go to bed or something. There's gonna be a pillow over my head when I go to sleep. That happens, dude.
I don't care.
I gotta be careful.
I'm not voting. Like, if the funniest thing is, all these people, right, when they look at like immigrants, they think about immigrants, and they're like, oh, the immigrants are only going to vote for their own people, right? Bro, most immigrants that I know, they fucking hate their own people, right? I'll give you an example. My mom is like a super, like, she's more MAGA than the white people. Like, she's a white supremacist at some point. Like, my mom's Indian, right? One time I was talking to my mom, and my mom was like, these goddamn Indians, there's so many of them. I said, Mom, you're Indian. She's like, yeah, but I'm not like them. They're just coming here and doing all this stuff, and I'm just like,
Clayton Bigsby. Clayton Bigsby.
So it's so funny to see that. And especially among Indians hate we hate each other. Okay.
That's what I've seen.
We will go into the room, right? And we will scan the horizon, like, oh, there's all these Indian people. So we will like each other to that degree. But then we also have this understanding that if too many of us are in the room at the same time, it just doesn't feel right. So it's like, nah, we don't want to be a part. We don't want the old country, we don't want the old country coming here and bringing all the bullshit from there here. So we can tolerate each other to a certain degree, But then if there's too many of us in the room, then we start to like, nah, man, maybe you need to go back to where you came from. It's like, bro, I'm from the same place you came from.
Yeah.
You know,
I don't want to get into Punjabs and Gujaratis and everything. Like, I don't want to get into that. So
yeah.
I don't want to bring that topic. This is going to be like an hour-long podcast where we start talking about that stuff.
Dude, Mexicans are like that too. You go to Texas, bro, all these Mexicans, they're like, yo, fuck these Mexicans. Like, bro, you're like two generations. When I was in San Antonio,
the same right? people.
When I was in San Antonio, I was in the Army in San Antonio, and I remember them, like, the soldiers who had like Mexican heritage, they absolutely fucking hated the Mexicans from like, they're like, these fucking illegals, they keep coming. I was like, bro, like, your parents were illegals. Yeah, but that's different. That doesn't count.
That's different.
Yeah, it's so funny to see that. Like, usually, like, you would think the most like, the races that come here and then they get legalized, right? They are the worst than not the KKK, but they're the worst when it comes to like self-hate. You know, it's just funny.
Yeah. I wanted to play a clip. We were talking earlier about Jon Stewart's show. He actually did a bit on Kamala. So I wanted to play a clip on there because what I was saying earlier was that like the Republicans thought it was in the bag, and then when Kamala was good, when they figured like, okay, Kamala's gonna come up and step to the plate, like they were kind of making a joke about it. You know, they were like, we still got this in the bag, and little did they know that Kamala's actually winning the polls. So when that happened, I really hope that I can share this and share the sound as well. But let me actually open this up.
There's usually like a little button at the bottom that has like a tick that says share sound also.
Yeah, I gotta open it up. Okay. Maybe you guys saw this episode. Hold on.
Yo, every immigrant is a Clayton Bigsby, bro.
Yeah. Clayton Bigsby. All right. Oh, can you hear it?
Yeah.
Is there anything else that could denigrate all of Kamala Harris's accomplishments by suggesting it's merely the power of the Jezebel?
It is relevant when a young candidate tries to sleep her way into politics and into power. And that is what it appears Kamala Harris did.
She's never earned or won anything. Like she was legitimately handed her original posts in California state government because she was sleeping with Willie Brown. And then he backed her in her race for San Francisco DA.
Okay, Squeaks. Listen, I don't know, guys. You're being awfully subtle here. Isn't there a grosser way you can say that?
Kamala Harris, she's the original Haktua girl. That's the way she got where she is.
That's what I'm talking about. That's the kind of substantive and elevated take from a guy who looks like he's one Mike's Hard Lemonade away from getting in a fight at his sister's wedding.
Dude, Jon Stewart is a freaking legend, man. Like this. I'm so glad he came back. Like, he's just such a legend, dude.
Yeah.
Anyways, I mean, we'll just see what happens, man. Like, they literally thought that it was gonna be a landslide, and then she came along, and she could possibly win the votes, man. We'll see what happens. It's gonna be a pretty interesting election. All right, so let's go on to the AI hype cycle. You've been pretty vocal about this as far as AI goes, the sentiments, the amount of spending that's going toward it. And one thing that you really brushed up on was the usage of the servers, specifically the recently upgraded servers that are utilizing the AI and inferencing and training services. So go ahead, man.
So my thing is AI is great. AI is here to stay. But the expectations on its profitability are still kind of in question. And I think this earnings, with the whole thing that we saw with Microsoft kind of not growing cloud as much, I think it's starting to show chinks in the armor with regards to how much AI demand is actually going to be there. And I think if it wasn't for AMD and Lisa Su coming out and basically like saving the market, I think we would have. Yeah, we would have got a correction, and it would have stayed down. And then goddamn Pelosi came in too this morning. You see that? Pelosi.
I saw that, dude. That was like, what?
Yeah.
You did buy NVIDIA before, and she bought AVG or Broadcom, and then she like doubled down on Nvidia,
Yeah.
and she sold Microsoft too. And
Yeah.
I didn't really notice that until probably later on the trading day, because I mean I was looking at the price today because of how volatile the market was, or in the up direction. But then I was like, why is Microsoft not moving this whole time? Like, it's just staying stagnant. And then when I saw that tweet, I was like, no way, this can't be it. Can the market really be like this, where like algos really based it on what Pelosi's actually doing in the market? Could be it, man. Could be it. Pelosi could be the ultimate chaser.
Yeah, but the point is, I think the chinks in the armor are starting to come up on the AI trade. So the ones that are likely to get hit the hardest is probably going to be the semiconductors, just because like how cyclical of a nature that the semiconductors are. I think there's a couple of major threats to NVIDIA that a lot of people, they don't want to necessarily recognize. And I'll go over some of them right now. Like the first one, I think, is just no one is going to want to pay the NVIDIA tax forever, right? Like right now, everyone is paying the NVIDIA tax, which is everyone is buying these GPUs at crazy high prices, because if you want to be in the AI game, you got to buy their GPUs. So I think all the companies, especially like Google right now has its own tensor processing unit, so it's different. But the other guys are all working on their own custom AI chips. Now they're far behind compared to NVIDIA, but that doesn't mean that they can't eventually catch up, right? And then also there are certain workloads where it just makes sense to be at the cheaper level. So as an example, NVIDIA right now, a lot of people, when I speak to them, they're like, oh, but next generation's GPUs are going to be even more powerful. And I'm like, that's like saying the next generation of Mercedes is going to be like more powerful. Yeah, but you live in like the 60-mile-an-hour speed limit. Like, what really is it going to help you with? You're going to buy something that's look good, that's going to have like good economy and everything else. Right now, when you first came to market, you had first to mover advantage. You had a very unique product. But now if demand is going to fall off, you are going to be a lot more cost conscious. And I think that's what we're going to see from the mega caps probably next year, and maybe even the rest of this earnings season, to just figure out like, okay, how do these costs play into the business model of a lot of these guys? Are they seeing the tangible results from all the investments that they're making in AI? And at what point do all of these, companies and their CFOs just come down and, lay down the hammer and says, look, you're spending too much on CapEx. You need to cut back on CapEx growth going forward, because like you're just not generating enough revenue to justify this spend. So we'll see.
I don't necessarily agree with you that the CapEx might be a little too high, because the justification for the current CapEx that these mega caps are spending is based upon the demand that they're seeing with AI. So in Microsoft's earnings call yesterday, there was that big fear, and you even saw Microsoft drop like 9-10% after hours down to the low 390s. And, people saw like the huge CapEx spend, and they saw like the gross margins kind of shrink a little bit at Microsoft, and they're a little worried, like, is this going to keep going on? Like the gross margin come down. And then when Amy came on the call, the CFO, she was basically saying, and which was actually unknown the whole time, but I guess the market needs to hear it in the call, the algos need to kick it off, was that this isn't just being spent on like AI and chips, right? This is data center expansion for cloud growth, for the high demand of cloud resources, right? So like their Azure revenue jumped up 30%, and that's no joke. I mean, you don't just jump up 30% in a $3 trillion company without upgrading your infrastructure. So the way that I see it is that accelerated computing is probably the better term instead of using AI. They're investing heavily into accelerated computing. Now, that doesn't mean that the market sentiment has not topped for AI, or I guess whatever these AI essentially related companies or data center companies. I do think that it's possible that we saw a near-term top on the likes of NVIDIA, a lot of the semiconductor stocks. I mean, I know Qualcomm's earnings today wasn't directly related to demand, had more of a revocation of a license they had with, I forget the name of the company. But just when you think of the sentiment, Qualcomm was up 10% after hours. And then it just immediately drops off like one thing that had to do with licensing, right? Which is probably just like a little blip in the radar, and then they'll recover it next quarter or something like that. I don't know the details on it, but the fact that it could really flip around that quickly, you could tell that the market's on edge right now. They're waiting to hear a reason to sell out of all this shit. And you saw that in the last couple of weeks. Like semiconductors got sold off pretty hard. Like ASML got sold off like over 20-30%. LCRX got sold off like 20-30%. NVIDIA got sold off over 20%. I think it was like 30-40%. And then it came back like 20% in one day. Like that just shows you how volatile this sentiment is right now. Like it's not the surety that people had in 2023 when it was just balls to the wall. Like, let's buy every single semiconductor stock. You know what? Let's buy Dell too, even though they're a hardware company at low margins. Let's buy them anyway. Like, that's not how this game goes anymore. Now it's like, you got to be sure what the hell you're picking. And I personally think that there's a reason why AMD didn't rally as big as NVIDIA did today. And one, it's Pelosi, baby. But two, also, look at their data center revenue, right? 2.8 billion. Okay, it was up 115% year over year, but it's only 2.8 billion. And I'm not saying that's, 2.8 billion is not a lot of money. Obviously, that's a lot of money. But when you think of like the degree of how much NVIDIA was growing, maybe they exhausted that, or maybe NVIDIA's growth might not be as fast and accelerated or meet the expectations of the market to retain its current valuation. So when you think of like, people are like, oh, let me just buy AMD instead. And then people just dove into NVIDIA maybe because of Pelosi. But maybe we are reaching that point where it's like, we got to kind of need to look at the long term here. Is this actually sustainable, this growth? Because people say that NVIDIA is cheap. And I agree. NVIDIA is a better deal compared to AMD. But once those earnings start to shrink or decelerate, then that cheapness might get thrown out of the water and their PE will just go sky high after that. And then it'll have to correct itself. That's what I think might happen, to be honest.
Yeah. No, I mean that's the scenario that I'm playing at. So I'm not trying to short NVIDIA or the semis or anything like that. To me, it's just like, okay, you know what? Let's avoid this. There's other places in the market that are a lot less volatile that we can play around in without having to like lose sleep overnight that like something came in wrong with earnings and now all of a sudden you're going to see this precipitous drop in the stock price. Like, like I said, you just have to know your own self as an investor. That's like one of the things I spoke about with Amit today on his market close, which is you have to invest based on you, not based on someone else. Like if someone else's conviction can be so high that they can tolerate a 90% loss, me, I can't do 30%. So for me, I'm like, okay, I'm going to avoid the 30-40% drop off candidates, unless I have like a lot of conviction in them, in which case 30% drop off is okay, fine. But the point is, right now, I just don't see a lot more upside in a lot of the semi names. If you look at their earnings are way above what's historically relevant. And at the same time, that by nature, semiconductors are very cyclical. So right now, everyone, because we're in the hype cycle of things, they kind of just like, oh, they're FOMOing into semiconductors. But eventually demand is going to drop off. And all this capacity that they've invested in, like for production, it's gonna be bad. So we'll see what happens. And I think 25 is the year that I think semis correct downward. I can't say that that's going to 100% happen, but to me, it's just like, let's just avoid the overvalued companies right now, especially when the market is already on edge.
Yeah. I mean, I think I do agree with you to a certain extent. But that's a thing, overvalued and valuation is dynamic, right? So what's overvalued today can be undervalued next quarter based on the numbers that come out, which is the reason NVIDIA has grown so quickly in terms of valuation. Not in terms of valuation, has grown so quickly in terms of stock price, but the valuation is actually better than it was in the previous quarter. I'm not saying that today's price, but that is what happened. But that's because their earnings have massively grown. So once that starts to slow down, or even slow down materially, or maybe it doesn't even grow a certain amount, it's the sentiment that's really going to drive the stock price at that point. So like for me, I was very overweight NVIDIA coming in. I didn't think the thing was going to move 100%. It was already a big position. So I definitely had to trim. But I got the position down to a percentage that I want, that I could definitely hold long-term and see through this volatility that we could be talking about, whether it's 30% drawdown or whatever. I could sit through that because it's not as big of a position where it's going to have such a huge impact. And it's pretty high conviction, and the same thing goes with Meta, Amazon, whatever. It's like, we're talking about mega caps, right? These aren't going anywhere. Like, to say that NVIDIA is going to drop 90% is pretty wild. That was like a once in a lifetime generational event that has happened probably in 2022 where it dropped that much. But to say that's going to happen again is like, I mean, it could happen, but from here, I mean, that's like the same people that on Twitter that are saying that Qs are going to drop like 30 points tomorrow or something. Oh, you're on mute.
All right, so I think that's about it. We have one more thing to cover, which is the cruise lines today, and I think that's about it.
Yep.
All right, so cruise lines, Norwegian, they had a great quarter. They had a record-beating quarter. They raised guidance again. The market didn't necessarily recognize that. A lot of people were focused on big tech and AI and everything else. So I think this was ignored a little bit. It did like have a moment where it was up pre-market, then got sold off a little bit, and then came back a little bit. And after hours right now, it's up just a little bit. CCL took a pretty big nosedive towards the end, but I think that's just volatility. Maybe a big whale got out of it. But the point is, the trade is good. Like you can see that the underlying factors that are impacting this business are on the uptrend, which means that longer term, eventually it's going to make its way into the valuation and make its way into the stock prices. So when companies, when you think about all these earnings, they're all sentiment checks, right? So if the sentiment's too high and they underperform that sentiment, then of course it gets sold off a little bit, and then the opposite happens on the other end. Sometimes you also get caught up in just macro level events that are just too big for us to ignore for an individual stock, especially one that's such a small in terms of like market cap. Like if you look at the market cap of Norwegian, even with all the ships that they have, everything, it's only about $7 billion. They have more debt on the balance sheet, which is about 13.5, and the equity is only worth about 7-8 billion. So what's good is that as the debt becomes cheaper to service, and as the debt goes down, a lot of that value is going to get driven from debt to the equity portion of the balance sheet. And so that's where the alpha really is for us. So that's why I think Norwegian is a value play. Carnival is a value play in that, where future growth is not going to be like super crazy, but what's going to be good is that the balance sheet improvements from rate cuts and also from higher occupancies and an incremental improvement in profitability, all of those things will drive shareholder value for the next 2-3 years. So I think of earnings as a way to just get a barometer check on the cruising industry. CCL reported a month and a half ago. They absolutely were like, hey, demand is great. Royal Caribbean last week said demand is great. Norwegian is saying demand is great. So now you have all the big guys saying demand is there. And what's interesting is, remember, a lot of the sales for these tickets, especially the ones that are really attractive, they were sold way before all this additional demand started to come to the market. So right now, a lot of these companies, the one thing that they keep highlighting in their earnings is, we're already starting to see a ton of demand for 2025 sailings. This is awesome for a business, because if you have demand that's out there and people are paying you ahead of time, a year ahead of time, that's basically an interest-free loan that you're getting. So when it comes down to it, we're in a good place. I think the cruise lines are very undervalued right now. Even during a recession, you're still going to see people going on cruises and stuff, because it is a higher tiered product that a lot of people are geared towards in the key demographics that these guys serve. So one
thing that is pretty interesting with this too is that the demand is growing. Like they've communicated that across all the 3 major cruise lines: Carnival, Royal Caribbean, and Norwegian. And you could already see like they're trying to grow capacity as well. So it's kind of like that. I mean, I don't want to say this is like the NVIDIA of cruise lines, but if you really think about it, the supply cannot meet the demand. So therefore the prices are justified, and the prices can actually go up based on the demand being high and supply being low. Like it literally is like, goes back to business 101, where it's just supply and demand. That's really what drives business. If you have high demand, low supply, prices can go up. That's just what controls price. You've got the pricing power. So, I mean, if you really think about this, like if they're booking cruises out a year in advance, that just means demand is high. So what exactly are they going to do to correct that? They're going to increase prices. And if they increase prices, that means their top line's growing. And if they're paying down a lot of the debt and servicing a lot of the debt and the costs pretty much stay constant, then that means that their bottom line increases just naturally.
So go to the slide at the bottom, the one that shows the net debt. Keep going. The net yield growth. That one was good. So that's good too. Yeah. So both of those slides are very important. So right here, the net yield growth. You know, you can see that from 23 Q2 to 24, it's a huge improvement in net yields. Right. This is like great in terms of profitability. But what's even nicer is that if you scroll down further, you can see that advanced ticket sales are climbing. Right. This is a huge improvement because now that means that you're able to do robust pricing, you know, so that this way your future revenue, when you start recognizing it, it's going to be even higher than today. So I love this. I love charts like this. Just really like give you a perspective on how healthy this current market is. If you scroll down a little bit more, keep going. They raised their adjusted EPS right here. Look at the increases that they've had with regards to their the thing. They've raised guidance 3 times in a row. Like, how many times do you get that? Like every quarter that comes out, you keep raising guidance. So like I said, this is one of those times where, you know, you just have to just buckle up and ride out the short-term volatility that's coming around because of macro level events, and enjoy the upside, you know. So I already pretty fully booked out in terms of my total position size. So I'm probably not going to be adding unless it really takes a hardcore dip. Then I'm like, okay, whatever. Then I'll go beyond some of my risk tolerances. But for the most part, I think this is where you want to be. You know?
Yeah, and boring is good when it comes to a good investment, right? Like, it's not supposed to be like growth stocks high and dry every single day. And you know, growth stocks is really what shows up on CNBC and gets a lot of the social media following because of their volatility and their massive growth in short periods of time. And people forget about these other companies that they're just printing money, and maybe in front of the woodworks, it doesn't look like that they're doing too well because their net income isn't that high compared to what it was before COVID. But if you look past that, you know, you look at their debt that they're servicing, like they paid their debt 6 months in advance, or they reached their target 6 months in advance to pay down their debt. And that just means more money to the bottom line, and ultimately free cash flow increasing. And that's like the kind of stuff that if they keep constantly guiding every single quarter, you're going to slowly get the inflows into the stock and create new floors in it. But as far as I see, man, it's just higher highs and higher lows almost every single time. So good enough for me.
Yeah. I think there's one metric all the way at the bottom in terms of like 2026 guidance. I think keep going all the way down for 2026.
Was it that
keep
one?
going? No, all the way down. More, right there. That one right there. Go up a little bit. One more. Higher up. There you go. That's what we're looking for 2026. This is their 3-year guide. So I think that they're easily going to hit that. So if you look at it on a CAGR basis for earnings, they're looking at a 30% CAGR for earnings. Right now, with about 2.45%, I mean, at $2.45 in adjusted earnings, you know, this usually trades close to between 14 and 15% PE. So we just use that metric. You can see that it's woefully undervalued for 2026 prices right now. So you take 2.45, multiply that up by, let's say, 14.
You said
that
4
should
PE?
be a good. 14 is the PE that it normally trades at. Not on a forward basis, on a current basis.
Okay.
So but this is for 2026, you know.
I could actually bring this up on.
Yeah.
I'll share this tab. Okay.
Yeah.
Oh, see, this is going to throw this chart off.
Yeah.
Well, hold on. Yeah, this is going to throw the chart off because of COVID.
That's fine. What's the historical PE on this thing usually?
Prior to
COVID.
Prior to COVID.
Can you go? Well, the thing is, it's only to July 2021, right? On that chart.
Yeah. Well, not prior to COVID. I think something happened 2 quarters ago where it just threw everything off.
No. So basically, they went from negative PE because you're, zeroed out. That's why you're seeing the PE being, downward to like this giant rise up. Because remember, this is usually a 12-month trailing or a quarterly PE thing. So can you go like further out with FinChat? Like go to like 2015?
Yeah, hold on. Let me share this tab. Okay. So I can't do quarterly though. I have to do.
That's fine.
I'll do trailing. Trailing's good.
Do trailing and then also do like prior to 2019.
No, you know what? I can't do that one. Okay, I got to do annual.
That's fine.
All right. So you want to do trailing?
Yeah. And just do it prior to COVID. So it's 2019.
Okay. I'll do December 2019.
No, you have to do prior to, not this.
Oh, don't include it? Okay.
No, don't include post-COVID, just include prior to COVID. So this way the chart doesn't look like waffly.
There we go.
Yeah.
And I'm not even sharing it.
There you go. So now look at the PE that typically it trades at between certain ranges, right? So if you look at it consistently from like 2017 to 2018, right, which is when their profitability metrics were there. So you can see it's right there in between 10 and 20 on average. It's gone down a little bit, but it's pretty much right there.
Yeah.
So
yeah,
that's the baseline. Yeah.
Yeah, and especially since that was before COVID. So they're paying down that debt, and they're not really going to have to do, or they're going to service the debt enough to bring it back to the point where their net margins can return to pre-COVID levels. And the gross margins have been pretty good since then. So there's a lot of wiggle room for the net margins to come up. That's really the kind of stuff that that people need to look for when they look for like really good long-term plays. More on the fundamentals and less on stock price movement. But at the same time, we think of the sentiment of cruise lines, like there's like no bullish sentiment on these cruises. Like they've been under 20 for a long period of time. Recently, they did go above 20, or at least Norwegian did. So, I mean, once that sentiment comes back in, it's just a matter of time. But day like today, where we saw tech outperform value, it will underperform today, even if they did report good earnings.
Yeah. For me right now, I'm looking at this. Their revenues are all-time highs. Their margins are starting to get back to what they were prior to COVID. And then if you take on debt reduction and, lower interest rates in the future, in my opinion, the 245, 250 is actually kind of low. I think they actually get to about $3 a share, $3 a share in earnings. So if you think about $3 in earnings, multiply that by a low end PE of 12, 14. You still get 13, not 13. You'd still get $36 a share in 2026 prices. So for me right now, this is easy play, for especially when it comes to the options market, because I think because it's been down so much, a lot of people haven't necessarily given a lot of credit. So we'll see what happens.
Rob was asking if we get into market rotation after this. I mean, I think we've said it more than a few times. I've been pretty vocal about it too, is that and I said it this morning on Amit's podcast, or Amit's Market Open. Really, I mean, you can only be so concentrated in the Mag 7 for so long of a period of time. But once those rates start to come down, the amount of debt that these smaller companies are going to take out will be at a lower rate. And then therefore they'll have more money to either spend or give back to the shareholder or on their balance sheet, whatever they want to do. But ultimately that will improve the sentiment of these companies, as far as of these small cap companies and even mid cap companies, as far as reaching profitability, growing their top line, bottom line, whatever it is, right? So once that sentiment comes back in, and the market's already trying to front run it, especially if you look at IWM or the Dow, once that sentiment comes back in, the money has to come from somewhere. right? Like there's only so much new money that comes into the market. It's pretty much rotating all around every single day that it moves. And that money has to come out of somewhere. So if you really think about it, it's a very good possibility that IWM, Dow, or even S&P, what is SP 600, has a lot of upside from here. So, just keep a lookout for that. Market's very dynamic, but just most important thing is risk management, man. Risk management. I think you're on mute, Kris.
I think that's about it for today. Are you doing anything later this week?
I'm going to Denver next week, so gonna enjoy
Denver.
That.
What's in Denver? Oh, just as a vacation?
Yeah, we got some family friends over there, and gonna just go to the water parks, see the kids out, let the kids have a good time at the water parks. Maybe do a little bit of hiking. We'll see.
Dude, SL Green is on a tear. I'm looking at it right now. It's almost $68 a share right now.
It makes me think, like, when I sold out at like high 40s, that was probably just the worst mistake I made. I didn't have a huge position, but it's just, if I think of the opportunity cost that I was calculating at the time, I did get into other stuff, but it's like I could have just left the money there and just not been stressed out.
Yeah.
How's it still going? It's going because rates are coming down. So people are diving into that good high yield. That's how it is, man. He's trying to pump his own shit. That's why.
No, I like, dude, my BPY PM and PN positions, they're doing well too. So I'm happy with those. Like, I love seeing that nice fat interest payment get dropped into my account every 90 days.
It's not still 10% yield, right? It probably went down because the price
it's about 11.
Yeah,
it's about 11% yield right now.
But your yield on cost is that's staying, 15. Man. That's still staying. That's pretty damn good. Wow.
Yeah. So I have capital appreciation on it, and I have that plus the security of it being in the preferred. It's awesome. Maddie has been making the most on it. All right. Maddie's been selling covered calls. So he's been collecting dividends and he's been selling calls. So he's SLG. So his cost basis is probably free money right now.
Yeah. No, that's good. And Matt's pretty good and strategic with his covered calls. Like, he's not doing any crazy Palantir wheeling.
That's not true. He's got caught off sides here and there.
I know, but like, he's got the patience. He's got the patience.
It's interesting. Me and Matt, we picked up DPST and TMF on our model portfolio, and I got a whole bunch of like replies. Hey, what should I do? Should I buy calls on this? I'm like, God damn it, man. This is one of the things with retail that you have to be very careful with, because like the greed comes in, and then you're like have to explain to them, like, don't get greedy. Stop. Like, for me and Matt, our portfolio, our target is to beat the market. But the thing is, the moves that we make are very, like, sometimes it could be very in and out very quickly, right? So if sentiment changes, we can be out of it very quickly. The thing is, as a retail investor, I don't have the latitude to go to everyone at the same time and be like, this is what you should buy and this is what you should sell. And I don't know their personal risk tolerances. So
yeah, that's different for everyone. Like, when someone asks you, like, should I buy this? It's like, there's so many factors in that, dude. I can't tell you whether you should buy something or not. And plus, like, we're not really giving advice anyway. We're just telling you what we do, what we think the alpha is. For me, like, I got into TMF on the Savvy account, on the Savvy Trader account. I got into it when I was in the 91s recently. But I've been in the TLT spreads probably for more than a month now. And then when it dipped back to, because I got the 95 and the 105 calls. So I bought the 95 and I sold the 105 for January 2025. And when it went to 91, I actually bought back the short leg for 50% cheaper than I sold it for initially. So I already made money on that. And then now I'm just holding the 95s naked right now. And I'm seeing that shit after hours, dude. Like, it's like, let's go. Like, whenever you see that shit out, it's like, let's go, man. Let's effing go.
Yeah. Now, just one of the things is, like, when people ask me, like, hey, should I sell this? Should I buy this? It's hard for me to give you a clear answer without knowing a lot of factors. So this is why one day we guys just got to do an ETF or a hedge fund or whatever, where it's like, look, you guys want to be in it? Throw some money into the ETF and And there you go. We'll make the moves. You know, you just got to pay us a little bit in performance fees. That's all.
I keep thinking, like, dude, me, Kevin, he did it the right way. He started an ETF. And I guarantee you, like, that's all he needs to do. He just needs to have the ETF, make sure the inflows are in there, and he's good to go. He's just collecting that fee every single year without doing much.
Let's take a look at what if he's actually outperforming the market or whatnot, because I think that's important. Can you put it up on TradingView to see if PP his PP
pricing
is he
power.
beating the market? Let's see. Is he beating?
Here.
In the past year, he's up 8%. Year to date, he's up 16. So he's not beating the S&P right now. So just go to the plus.
Right?
Yeah, do a percentage, and then over at the top, just add SPY. Yeah. Enphase is probably killing him, bro.
Dude,
he's literally performing right at the market.
He's performing the market, but he doesn't care. Why would he care? He's been collecting the fee the whole time. He's been collecting the fee the whole time, and he's advertising himself every single day on YouTube with 1 million+ viewers all the time. Like, why would he? Like, at that point, it's like you're performing the market. You know, that's all it is. And now he's into the day trades and stuff. And that's like a money maker right there. Like, there's nothing more degenerate than you can get with selling day trading calls. Like, I mean, you attract a different crowd when you do that. But I mean, as a businessman, dude, yeah,
I'm all about performance. Like, if I can't beat the market, then I need to just close up. Like, I'm pretty sure I won't be able to beat the market like every single quarter for the rest of my life. But dude, historically, so go back to it. Let's see. On a 5-year basis. On a 5-year basis, did he
have it for 5 years already?
Maybe 3 years. I think he's had it for 3.
Let's see here. Try the 1 year. 1 year is good. 1 year he is underperforming the market.
Okay.
5 year he is outperforming the market.
So since he started,
7%,
which is in 23,
yeah. But
so he's
I mean,
underperforming. Okay.
He's actually, I don't know. Like, when you think about the money that's inside these ETFs, he's probably got a few whales in there, but for the most part, the money rotating around every single day is very likely just retail traders just trading out of it every single day. So I don't know. Whenever I see like an ETF, I just want to look at the holdings, and then I'll just buy the holdings that I think will have the most amount of alpha.
Do you want to do a quick portfolio analysis and see what he has? If you have a minute, yeah.
Okay, 1 minute, man. We're talking about stock market. I can't say no.
Yeah.
I actually got to share that screen. Okay. Me, Kevin, pricing power ETF. Like, how
he played the PP thing, man. It's just funny. Yeah. It's like, buy my PP.
Oh,
so he's mostly in cash.
Like, yeah.
So he's mostly in cash. His biggest position outside of that is Trade Desk. 100%. I know he went uber bearish. Enphase, which has been his bigger issue. Ubiquity.
Trade Desk was good, dude. That thing rode up hard. I'm not in Trade Desk anymore, and I want to get back in, but the damn thing is just so overvalued. But at this point, I'll just hold Meta for now while I'm waiting. But yeah, Apple. So he probably got a lot of upside from Apple. Definitely with Tesla. He keeps talking about Ubiquity, man. Do you know what Ubiquity is?
Isn't it like some kind of like fiber optic networking company or something? Or do they own the thing or own the?
So Ubiquity sells networking hardware, Wi-Fi access points, routers, switches, and so on. But their shit is like top grade, dude. Like really top grade for retail. And they also sell a lot to SMB or small businesses. And when this thing was like in the hundreds, you can have a good company, but if the business isn't really ran well, then it's like, why would you really want to buy that company, even though you know it so well? But like, this thing doubled in just since last October, basically. It just doubled. So he definitely saw the upside in that one. Enphase, I mean, that shit's just in the same place. He's got Amazon, which is pretty good. TSM is pretty good too. What's this?
That's an airline. Well, not an airline. It's a it's an aircraft manufacturing company, Embraer.
Oh, okay.
So they make jets.
Yeah.
They're like the number 3, I think. Yeah, they're like number 3 usually
Okay.
in that category. You know?
Okay. And he's got ASML, so he probably got pretty hit hard with that one. I mean, it's all tech for the most part. So it's gonna if you really think about it, would you rather buy the Qs or rather buy this? And I'm pretty sure the Qs outperformed this by a landslide.
Yeah. I mean, it just depends. I think right now people should be looking outside of tech. You know, there's a lot of opportunity out there. Everyone is so tech focused these days.
It's good to
Just
diversify.
looking for it's good to diversify, you know, hedge your positions out a little bit.
Oh
yeah, there you go. QQQ
vastly underperforming the Qs by almost 20%. In the 1 year, he's underperforming both of them. Year to date, oh wow, the Qs are actually same as the SPY year to date. It's pretty crazy.
Yeah, it's because the last couple of like trading days, the Qs have been absolutely hammered. You know?
That's true.
So
yeah.
All
right, man. Well, thank you very much, Evan, for attending. Of course, this is recorded. It'll be available right after. But you guys have a good night and have a good week.
Take care. Have a good one.
Later.